For those of you not familiar, he is the author of a very popular book, Options as a Strategic Investment, and he also manages option-oriented accounts for certain individuals. He's an editor of many publications, daily as well as weekly. I've listed here a number of them, and he has been a longtime speaker at many major trading conferences, as well as has appeared on CNBC and Bloomberg TV. So without further ado, I'd like to go ahead and have Larry talk to us about options and the broader markets. Larry, are you?
Yeah, I'm there. Thanks, Mariel. Let me just
Super.
share my screen here.
Great.
Okay. So we're going to spend a few minutes here talking about what the option indicators are saying about the market. Mary Ellen did a good job of explaining, what our company is. Just briefly, we do money management. We have a lot of derivatives research, including newsletters, and then we do some option education as well. For those of you who are more interested, the link optionstrategist.com/MEM will get you to a landing page where you can see some of our services at deep discounts and also get a PDF of this presentation. All right, well, let's get started. I typically look at four different things. I mean, there's subsets of these, but the chart of the S&P 500, of course, equity-only put-call ratios, market breadth, where we have an option-oriented take on that, and then volatility VIX. The one important rule that I always stress to people is that the declining market, oversold does not mean buy. You have to wait for real buy signals to occur. We saw that in December, for example, when the market was oversold almost the entire month. And conversely, overbought does not mean sell either. Now we're starting to get some overbought conditions, but we don't really have any confirmed sell signals per se at this time. So here's the chart of the S&P, which Mary Ellen just quickly referred to. The thing that I find a little problematic here is that we're basically dealing with a triple top right now. If we can break on through here, then we can leave that in the dust. But it seems to happen that every time we get back up to this level, and you're basically finding that the market's kind of out of firepower by the time you get up here. There's great support down here at the end of May lows, which were the same as the early March lows. So if we were to back off, I wouldn't think we'd go that far, but there is support down there. So essentially, the chart is still bullish despite that potential triple top, as long as we don't break support at 2,900. There's another thing that we look at, modified Bollinger Bands. When John Bollinger invented Bollinger Bands, he defined volatility as the standard deviation of closing prices, which makes sense. But in the math or the option world, and in math departments and universities and things, they use a different definition, and it's the standard deviation of percentage daily closing price changes. So it's a little bit different, but we need to stick in our business. We need to stick with Black-Scholes definition. Otherwise, our implied volatility models would not match those of anyone else using Black-Scholes, and that wouldn't be good. So we draw Bollinger Bands using that definition of volatility, and we look for moves outside of the plus and minus 4 standard deviation bands, 4 sigma bands. And when we get that, a signal is setting up. So right now, we're actually getting a new sell signal setting up. So the top band here that's plus 4 sigma, and then the one just inside there is plus 3 sigma. So we get a sell signal when we move above the top band, which we have done right now in the last 2 days, and then later fall back and close below the next band. So right today, for example, we'd get the sell signal if S&P closed below 29.29. That's 24 points below where we are right now. So probably not going to happen today, but it might. So you can see other buys and sells marked in this chart. The red letters are successful signals. Some of them have been really, really very good signals, like the one coming out of the bottom here. But even here last October, you had a pretty good move, and obviously the sell signal. But the ones marked in blue are not. They get stopped out fairly quickly. But right now, the system has been overall profitable for a long time, number of years. And so we are pending a sell signal there. I would say, again, we're overbought, but not really a sell signal. The next thing we look at is put-call ratios. Put-call ratios were invented by Marty Zweig back in the 1950s. And very simplistically, to predict the broad market, we look at equity-only put-call ratios. That's all stock options that trade. And it's a contrary indicator, so if we can define what it means to say there's too much put buying, if everyone else is buying puts and everyone else is bearish, then we want to do something bullish. Conversely, if everyone else is buying calls, that means they're all bullish and we want to do something bearish. So here's just the simple ratio. Let's say we have IBM. At the end of the day, we sum up the volume of all the puts traded in IBM, and separately we sum up the volume of all the calls, and we divide the two. So put-call ratio. Since puts are in the numerator of the fraction, heavy put buying generates higher numbers. The ratio goes up. And since calls are in the denominator of the fraction, heavy call buying, which would occur in bullish markets, makes the ratio go down. So the ratio actually is moving in the opposite direction from stock prices. We keep a moving average. I use 21 days just in case there's something to Fibonacci. And this is what we theoretically would have in a perfect world. The stock price on top would be moving inversely to the put-call ratio on the bottom. For example, let's say as the stock is declining, during that time, people are buying puts and the public or whoever is right during the trend. But then at the end of the trend, they tend to overstay their welcome. Everyone's loading up on puts right here. When the put-call ratio rolls over and makes a local maximum, that's a buy signal for the stock, and then the stock goes up. Conversely, down here, when the put-call ratio bottoms out and makes a local minimum, that's a sell signal for the stock. So this is not a current chart, but I just want to show you this. On top is the S&P 500, and on the bottom is the equity-only put-call ratio. So you can see that, in general, they move inversely to each other. That's why we use the equity-only put-call ratio as the predictor for stocks. So here's the current signal, and the most recent signal we had was a local maximum on the put-call ratio, which is a buy signal, and that occurred right around the 1st of June. So we're still operating on that buy signal right now. Up here is an unscaled chart of the S&P 500, and that's good. We had a sell signal in early May, which was also good. We had a kind of a double buy signal last fall, but the higher one coming in right after the first of the year, and of course that was a very good one there. Interestingly enough, that was the highest the put-call ratio had been since 2008. In other words, people were more bearish then than the only time was 2008. But just a few months before, and not that many months before, last summer of 2018, where we got a sell signal here with a local minimum in the chart, that was the lowest. In other words, the most optimistic people had been since 2014. So people went from extreme optimism to extreme pessimism in just a matter of 6 months. But that's the way the market works. And this is one of the indicators that can help you determine what the feeling of the market is. As computers came along, we were able to refine this a bit and compute the weighted put-call ratio using dollars. So at the end of the day, what I do here is I take, let's say on any particular option, we multiply its price times the volume it traded that day, and that's how many dollars were spent on that option. Now, obviously, we could do it with individual trades all day long. I haven't found that adds much of anything except just grinds out a lot of computer power. So we do it this way at the end of the day. And again, with IBM, let's say we make that calculation for all the options, and we sum up that dollar volume calculation for all of the puts. Separately, we sum it up for all the calls, divide the two. And now what we're measuring is the dollars being spent on bearish opinion versus the dollars being spent on bullish opinion. We'll generally get more extreme readings, but not necessarily different in timing. So you can see here, for example, last December or January, the ratio got all the way up to 180, which meant $180 were being spent on puts for every $100 being spent on calls. Now, in terms of stock options, that's really, really bearish. I mean, that's a lot of puts being bought. And again, that was the highest reading since 2008. So that matched up with our other chart. You can see that earlier in back when people were all bullish in the summer of 2018, that it was as low as it had been in 8 years at that point. So very extreme readings. We did get a sell signal in early May, and now we're operating on a buy signal because there was a local maximum on the chart at the beginning of July, and that's the operative signal right now. So the put-call ratios are bullish, and until they reverse direction, they're going to stay that way. So they don't change direction quickly, and they don't flip-flop back and forth too much. So this is a nice intermediate term buy signal. We don't have a lot of time today, so I can't really talk too much about option trading per se. But one thing I would like to mention to you is that when you see on TV, it seems like, especially on CNBC, most of the traders are doing a spread. Every time they have a trade, they do a spread. That's not how I view real option speculators, professionals trading. You use a bull or bear spread only when options are expensive. Options are relatively cheap right now, so you don't really need to do that. The reason is you don't want to cut off your profit potential. So that I realize the other option you sell brings in a little money and it costs you less for the spread to start with. Well, if you're concerned about how much money you're investing in the trade, then buy a few less contracts. But don't spread unless the options are expensive. If they're relatively cheap, you're just cutting off too much profit potential when you use a bull spread or a bear spread. Anyway, back to the subject at hand. Just want to show you a couple of individual put call charts. This is Boeing, and you can see Boeing has a bunch of decent signals. Now, on individual stocks, we only use the real extremes. So I wouldn't consider this little thing in here to be a buy signal, even though it's a local maximum on the put call ratio chart. Nor would I consider that to be a sell signal, even though it's a local minimum. I'm looking for these outlying extremes here that I've marked with the red letters, and you can see they've all been pretty good. And so now recently, everybody, of course, got bearish on Boeing as the news about the crashes and everything came out. And we did get a buy signal right just after the 1st of June, but we waited for the stock to break out over this little resistance level, which it did last week, and then we went long. So now we're long Boeing based on this signal, and looking for this ratio to come down eventually would give us another sell signal. Another thing that we can monitor individually is futures options. So this is a live cattle. The top line is the chart of the continuous futures. The bottom line is the put call ratio. You can see the red letters, again, indicating successful signal. So we had a real good sell signal, a local minimum from an extreme level. And now we've just had a buy signal, but we actually haven't acted on it yet because the stock is wedged in this little wedge pattern here, and we're waiting for an upside breakout to buy. If it doesn't come, then we won't buy. Specifically, we're looking for August futures, live cattle futures to trade at 107. And they're only at 103 right now. So, that buy signal is not exactly imminent. All right, let's move on to the next topic, which is breadth. And breadth is just the difference between advances and declines. We keep a cumulative total of that, and we also calculate an oscillator, which we define as 10% of today's advance, 10% of today's advances minus declines, added to 90% of yesterday's oscillator value. So you have to know yesterday's oscillator value in order to be able to use that. But we have a stocks-only approach to this. We don't necessarily use New York Stock Exchange data. We do keep that. But we have a very good set of stocks, all optionable stocks. There's a lot of them, though. Some are NASDAQ, some are New York. They're all over the place. So that makes a pretty good representative sample, and so we keep the same oscillator based on optional stocks only. And the way it goes is this chart, by the way, goes back to 2013, and the oscillator is oversold if it gets below minus 400, and overbought if it gets above plus 200. Now, remember, again, we said, oversold doesn't mean buy. So last December, this thing went to the most oversold reading it had in history. And then here's where your buy signal comes when you come out of oversold. Now we went up into overbought territory. We came out, we had a little sell signal there beginning of May. Now we're back up here in overbought territory, and that's fine. As market's breaking out to new highs, I actually would like to see it be even more overbought, because that indicates the rally is even broader than possible. But in January here, we got extremely overbought, and there are a number of people, I'm sure you read these kind of comments back in January, that the people, that when you get these extremely overbought readings, that has some longer term bullish implications for the stock market. So we did have those extreme overbought readings. We'll see how long they can have influence, but sometimes up to 6 months or a year later, the market is still kind of feeding off that buying frenzy.
And just to, so it's not until that crosses the red, goes down to that area where it turns blue,
right?
Until you see that occur, all systems go.
Yeah, exactly.
Perfect.
Then so the breadth, we had buy signals from these oscillators in early June, and we're still hanging in there with them. Now the last thing we look at is volatility. VIX, of course, the CBOE's volatility index. First of all, we look at the trend of volatility. It should be trending opposite to the market, or be trendless. At least if it's trendless, that's bullish. There are spike peaks occasionally when the market sells off sharply. We have a system to trade those for buy signals. And again, when VIX is low but not trending, that's still okay for stocks. So here's the VIX chart right now, and there's a couple of things on here that are important. First of all, you can see these VIX spike peak buy signals. Again, the same nomenclature applies. Red letters were successful signals, blue were not. But here's your 200-day moving average of VIX right here. And it's just above 17, and I'm considering that pretty important. As long as VIX stays below 17 and just kind of waffles around down here, then that's fine for stocks. Stocks can continue to go higher. But if it goes above 17, I'd begin to get worried. So again, right now it's bullish because we're below 17, but if we went above there, we'd have to be a little bit concerned about it. Another thing that we look at is how much premium there is on the VIX futures, and whether the term structure of the VIX futures and the term structure of the CBOE volatility indices, there are 5 of them, how we align. So right now, the futures are trading at a small premium to VIX, which is mildly bullish. The term structures of both these things are sloping slightly upwards, and that's mildly bullish as well. So while I've seen more bullish constructs from volatility derivatives, and being on a new high in S&P, I would have thought maybe we'd see a more wildly bullish one. We're not. So it's somewhat bullish, but not crazy. So just to summarize these things, the S&P chart is bullish. The PutCall ratios are on buy signals. The breadth oscillators are remaining on the buy signals that they gave not too long ago. VIX is not trending, and it's at low levels, so that's bullish. And the construct of that I just talked about there is mildly bullish. So overall, bullish. And it seems like this is like wonderful, nothing could be better, but we are banging up against that resistance now. And there are a couple of other things that we watch for. One is new highs versus new lows. Right now, that's fine. There's more new highs than new lows, but for example, back at the beginning of May, this indicator turned negative before other things did. So this is one thing we want to keep a close eye on, and not necessarily the New York Stock Exchange data, which is sometimes overly bullish. Pay attention to the NASDAQ data, which is published every day on the website of the Wall Street Journal. We also calculate one using stocks only, but you wouldn't have access to that unless you were one of our
And
subscribers.
Larry, what warning would we be looking for as far as the number of new highs versus new lows?
So we'd want to see new lows outnumbering new highs for at least 3 days in a row, while the market is not necessarily breaking down yet, just kind of maybe going sideways or slightly lower.
Very interesting.
And then one last chart. Mary Ellen referred to this, that IWM is the Russell 2000 ETF. You might know that better as RUT. And then, of course, SPY is the ETF for SPX. This ratio has been declining since July of 2018. I mean, there was a reflex rally here where everything was rallying in January, February. But this is a negative divergence. And while it might not necessarily have immediate short-term buy and sell signals associated with it, it's still negative. And you can see that even though recently here in June we've broken out to, we rallied back and regained all the losses in May on S&P 500. This is barely edged higher. So this is a negative, and how much importance we can put on it, I don't really know. I would certainly not want to just go out and short the market based on this. But if the market does begin to generate other sell signals, then I would be, watching this as well, because it has been pretty good. Last fall, it broke down before the market did. It started to negatively diverge. If you recall, in last July, August, September, S&P was going to a new high, and this was falling back off its new high. So that was a very good divergent sell signal at that time. Right now it just hasn't recovered from that, and it's this year now. It's obviously since March been doing poorly as well. So overall, pretty bullish. We're keeping an eye on things. One last thing I want to mention: we have a day trading program that we have over at RJ O'Brien, and it trades E-mini S&P futures in our day trading system that I have used for years. It's a $10,000 minimum account. You put up the money, you pay $50 a month for access to the system, and then it automatically trades. Whenever we get a signal, it automatically trades in your account. Overall, the long-term track record of this system is 57% wins, and the average win is bigger than the average loss. So if you know anything about short-term trading systems, you know that's a very attractive setup. More wins than losses, and the wins are bigger than the losses. So if you're interested, give us a shout. As I said, the newsletters can be looked at on this page. And then this is my contact information here. So if you have any questions or want to talk to us about that Echo Trading account, feel free to give us a call. So, Mary Ellen, I'm going to shoot it back to you. I think we got
wonderful. Yeah, that was really very, very well done, and gives us a wonderful sense of your focus. And I think we still have another minute here as far as getting a feel for how, might take a little too long for this, but how you uncover individual stocks. Do you use those very same indicators that we just viewed in order to then drill down? I'm not sure if you have sections or areas in the market that you focus on.
Right. Well, we look at put-call ratios on over 500 things. So a lot of them are individual stocks that are also ETFs and sector trading. Mm-hmm. That's one of our main indicators. But in our Option Strategist newsletter, which is our oldest newsletter that comes out once a week, we have a number of other things that we look at. Specifically, we do a lot with earnings, options, how they're priced before earnings can sometimes give us a clue as to what's going to happen. And sure, we have a good track record with that too.
Oh, wonderful. So essentially you are constantly screening the markets for those candidates using those put-call ratios and many of the other different signals that we just looked at.
Yep.
Wonderful. Right. Very good. Larry, I want to thank you very, very much. Very informative.
And thanks for having me.
Yeah, we'll of course keep an eye closely on this market and make sure we're still in good standing.
The Chart Watchers newsletter features expert technical commentary about the current market from some of the industry's leading technical analysts. See what's really happening in the markets through their eyes and gain an edge in your own investing. The newsletter is packed full of insightful and educational articles intended to help you become a better investor. Whether you are brand new to charting or a seasoned technical analyst, each edition will provide a wealth of informative content. It's the best way to stay informed on all the latest news, events, updates, and additions here at StockCharts.com. Whether it's a new feature or blog, an upcoming conference, or a special sale, you'll hear it first in the Chart Watchers newsletter.